Good morning, everyone. Welcome to this update for global stocks and commodities for the 16th of September. This week, I want to address, I guess, a topic that's always important, but because markets, particularly in the US, have been going up quite nicely, and some parts of the Australian market have really risen to what some people regard as excessive valuations. I just want to provide a perspective on this question between being on stocks that have got tremendous upward momentum but have perhaps reached a valuation which is starting to get a bit extreme, and the rest of the market, which a lot of the traditionalists would call the value end of the market, where you can buy stocks that are trading below their fair valuations, but sadly, the share prices haven't really been doing anything for some time. So I think it's a really important question to look at. So let's jump in. So the question of momentum versus value, and there's both positives and negatives here. One of the potential negatives is that there are a number of factors, and I've spoken about this before with respect to ETFs. How the buying mechanism around ETFs actually creates a bit of a self-sustaining spiral in the upwards direction until, of course, it reaches some sort of trigger point where it can then reverse and it all unravels as badly as it possibly can. Now, we haven't seen that yet, but there's been enormous growth in ETFs in the last 10 years. And no one really understands how that's going to play out from a liquidity point of view if we do get that reversal. And I'm seeing something similar in the Australian market as well. So there are multiple factors that are driving a lot of these stocks. And I'm going to show you three Australian stocks that have made fantastic gains in the last 12 months to 2 years. But are now trading on quite extreme valuations. And of course, while all this has been going on, the value stocks have been very, very much left behind, as has the Australian, the Australian index. So it's really a question of how to play a rising risk environment. How do you continue to participate in the wonderful gains that are on offer, but minimize your risk, and don't expose yourself to potentially too much damage. So a really interesting question to look at. The normal stock and commodity trend update, of course, and portfolio analyst last week, as I promised, I was taking a really hard look at the concept of relative strength, which is a very valuable one to understand and to exploit. And we looked at some emerging trends, and in particular drilled down into a couple of industry groups that are offering good opportunity, one in healthcare and one in consumer staples. So again, perhaps moving away from the technology sector, which has done incredibly well and will probably keep rising, but the risks at the moment are perhaps a little higher than you would like. So just a perspective on the market. There is a lot of hot money sloshing around, particularly in Australia, but also in America and in Europe. And we're seeing that through things like the number of private equity deals that are being pursued with what doesn't appear to be a lot of due diligence. There's some fairly hot IPOs that don't appear to have a lot of substance behind them. So it all sort of smells of money that's being pumped into the market on momentum rather than on proper diligence. And as a consequence, we are seeing some extreme valuations in the growth stocks. Now the difficulty is really understanding at this stage whether those valuations are in any way reasonable, because the growth rates are just so high. And certainly with some of these stocks, there is an awful lot of blue sky has been priced in, But in some instances, it may be justified. We just don't know at this stage. So the question that I raise is, are passive funds, so index funds that basically are following along with the momentum of the market, are they fueling the same upward buying spiral that has been propelling some of the ETFs as well? Now, in America, I'm far less concerned about that because the rise in the stocks and therefore the rise in the ETFs is underpinned by very strong fundamentals at an economic level, at a corporate profitability level, and also generally at a valuation level. I'm not really seeing, as a general statement, valuations in America that concern me. Yes, there are some pockets of overvaluation, and they occur in mostly in the tech sector, but I'm not sort of seeing it at a general market level. Beg your pardon. So what we've got is a situation where the growth stocks, the stocks that have got big very quickly, are in fact getting bigger, and that's that's just a fact of what's happening. And the rest of the market is being left behind, and that is very much the case in Australia. So the bottom line for me is that risk has been mispriced since the GFC. Now, there's been a lot of discussion about that over the years, and there's probably no question that that has been the case. And if you think back a year or two, we had the absolute absurdity in Europe of negative interest rates, and I think even zero interest rate mortgages. I mean, that was just absolutely crazy. And while some of that has now eased, we've still got a situation where risk, particularly in the bond market, is still being significantly mispriced. And of course, that just causes distortions across the board. Now, this phenomenon is cyclical, but it is quite a big picture cycle. We've had mispricing now for a decade, and at some point, it's going to bite quite hard, and we're going to see a lot of reversals, and we're going to see some very volatile markets. So eventually this spiral is going to stop, and there's going to be a lot of tears and a lot of inexperienced people who get drawn into the market when euphoria starts to take over are going to get hurt very badly. And that's why becoming more educated, becoming more knowledgeable on the market is so important. And that's why I do these weekend videos, to try and provide that perspective that will avoid some pain for the less experienced in the future. But I don't know where that point is. I really don't. It could be 2 years, it could be 10 years. I have no idea. I just know that eventually we will reach that point, and therefore it's important to understand what the signals look like. What are the things you need to be aware of? So before I get on to what should you do, let's just have a quick look at a couple of the stocks in Australia that I'm talking about that have raced up really, really strongly and are trading on price earnings multiples generally above 100 times. Now, Afterpay Touch, I think, is a stock that's had plenty of media coverage, and lots of people are talking about it. And it was only in May of this year the stock was trading below $7, and then it whipped up to 23, and now we're still trading around the 17 mark. It's very hard to value this stock at the moment, but there's no question that it has enormous upside potential. But if anything goes wrong, then these are the sort of stocks where the share prices can lose 20, 30, 40% in a single day. And of course, that's the danger in these sort of stocks. And that's why I'm really addressing this issue and trying to provide a perspective. So I'm not saying you should not be in these stocks, or that if you're in them, you should get out of them. What I'm saying is that you need to have a very robust trading plan, and you need to be very alert to the signs that maybe things are coming off the boil. Another high flyer has been a stock called Appen, which is another Australian technology stock, and you can see there's been a tremendous trend there that's this year has basically taken the stock from around $6 to about $14. And again, that would appear to be priced for perfection. And there's quite a few of these stocks. There's a few dozen of them, but the third one I want to highlight is another stock called WiseTech Global. Now, these are really good companies. I'm not saying that they're not good companies. They are. It's just a matter of valuation. So WiseTech Global is another stock that is trading on a PE of in excess of 100. But the growth rates in earnings equally are extremely high. So is 100 justified? I suspect not. And would you be better off getting in at a lower valuation, perhaps somewhere around the P of 50, 60? I think, yeah, absolutely. The question is whether the market will provide that opportunity. So hopefully this perspective is helpful. And now let's turn to the question of what should you do in this sort of environment. So I think in general, you should not let any individual stock become too big in your portfolio. And my rough rule of thumb is 15% maximum. Once a stock gets to 15% or above as a percentage of your total portfolio, nothing is ever guaranteed and for sure. So I would look at trimming exposure on those sort of stocks. Take some profit off the table, and don't let any individual stock get too big. Avoid getting greedy. I know it's easy to get drawn in and think, well, this is my best performing stock. It's 20% of my portfolio. I really should stay with it because I can really make a killing. But that's the wrong way to think. You need to think, first of all, about risk, and secondly, about potential profit, in that order. The next thing you can do is just be aware of your portfolio diversity. Don't get too heavily skewed to any particular sector or any particular stock, or in fact any particular geography. Now, I know that a lot of people that I communicate with don't trade internationally. They don't trade in the States. I think that's a huge mistake because the opportunities in America, and also just the potential for the currency gains that have been quite attractive in the last year or so, have really made that a very attractive investment alternative. But just look at your portfolio, and I think just don't get too heavily weighted to any particular theme or any particular sector. And then you want to buy when the odds are favourable. Now, I've covered this before, and I cover this constantly in Portfolio Analyst. And those sort of opportunities occur with a decent dip in a strong uptrend is one opportunity type. The next opportunity type is the start of the markup phase during an accumulation base, or a reaccumulation, which is basically a sideways band in an uptrend. So there, when the two most favourable entry opportunities present themselves, and if you don't quite understand what that means or what it looks like, then you absolutely should get yourself into Portfolio Analyst via the free trial, because this is what I just do extensively every single week, and coupled with some terrific members' questions, uncovering stocks that I was unaware of. Between the group, we're certainly unearthing some tremendous opportunities. The next thing you can do is to absolutely avoid chasing prices. If you look at the APTs and the WiseTech Globals, if you start trying to chase those prices when they've been running up strongly, there's a very good chance that you're going to get whacked fairly hard at some point. And the final thing is, don't be impatient to get back into a screamer, a stock that you've done extremely well out of. If a stock has grown and you've trimmed some profit, don't be too anxious to get back into it, because quite often that consolidation phase could take anywhere from a couple of months to 6 months. Once the stock has really roared up, you then get a beg your pardon, you then get a consolidation phase, and that doesn't that usually doesn't play out with just one dip and a rebound. So don't be too impatient to get back into those stocks. Just recognise that they'll take a while to settle down. Other good low-risk entry opportunities will present themselves. You just need to wait. And this is where having a really large portfolio of opportunities is so important. You just go and focus your attention on other stocks. All right, let's turn to American stocks. The S&P reversed back up, so it's just really been going up and down now for 3 weeks. So it's been going up and down by about 30-odd points each week. And there are some hefty valuations in America, as I mentioned earlier, particularly in the tech sector, in software and business services, particularly around software as a service, that industry group. But equally, the S&P is trading on a general PE ratio of around 16.5, which I think for this environment and the momentum is about right. So I think the market's pricing things pretty well in the States at the moment. Now, I do note that the transportation index and also the aerospace and defence index both broke out last week after lengthy consolidations, and that's a real positive. So at least some parts of the market are not extended, because when sectors like that have been consolidating for a long period of time and then break out, that generally that renewed uptrend then generally goes on for some time. So that tells me that there's still good momentum in the market when we're not getting too hot, and there are certainly areas that that can provide good opportunities. I think on the S&P, a breakout above 3,000 points is the higher possibility at this point in time. September is often shaky, so I'm not saying you should go all in at this stage, but I think between now and the end of the year, we're going to see the S&P above 3,000. The US dollar was down slightly on the week, and there's a real mixed bag of sentiment at the moment. It's just going backwards and forwards to a large degree, depending on what Trump is tweeting at the time. And, that makes the currency market fairly tricky at the moment. But there does appear to be some progress being made on trade, and I think eventually we're going to see that settle down. Let's jump in and look at some charts. And I'll start first of all with the breakouts. So let's look at, this is the transportation index. We're looking at this on a weekly chart. So right over here on the left-hand side is 2011. So this is quite a big picture view. You can see we had quite a lengthy pause in this uptrend from March of 2015 to January of 2016, so about 10 months, and then the uptrend resumed again, and it's taken it from around 120 to about 210. Now, just recently, you can see that we've had a pause in proceedings, and that started basically in January of this year. So we've had a consolidation, and then last week you can see we've just broken above that consolidation. And importantly, getting back to the question of relative strength, we're now just seeing the relative strength line, so the transports are now starting to outperform the general market. So the odds are now that this will continue to kick on. Generally, when the transports are doing well, the whole market is doing well. The other sector that looks great also is aerospace and defence. Very similar pattern to the transports. And you can see it actually started to move higher just a week or two ago. And we'd also had a consolidation there since the end of January. So around about 7 or 8 months of consolidation. Very nice breakouts, and they're both really good signs for the market as a whole. Let's look at the S&P. So we've just been going up and down since we broke above this January peak, and clearly the path of least resistance is to the upside. The Nasdaq, similarly, just a little bit off its highs. It is underperforming the S&P just a fraction in the short term, and that's because there's just been a little bit of a cooling in some of the FANG stocks, Amazon and Google, etc. And finally, the Russell. The Russell's still looking very strong, as you can see. We broke out of another consolidation here from June. So far, it's been a very shallow pullback, retested the breakout, and the small cap sector is still looking really good. So with technology and consumer discretionary sectors still being very strong, the risks are a little bit elevated there, but those two sectors looking great. We've got transports and aerospace and defence now breaking out. We've got small caps doing well. You cannot deny the US market. Those that love to call a top in the market and tell you that the sky's going to fall in certainly don't have the facts on their side at the moment. Okay, that's the American stock indices. We'll just check in on the currency. So we had a big breakout in the middle of August when the fears were at their highest about the trade wars. But since then, we're just continuing to fluctuate around this 95 level. While I'm here, just look at the consequences of that for the Australian dollar. So the Australian dollar broke down, and as I pointed out last weekend, we broke this key support level on Friday. We managed to rally back above it when the US dollar fell, but clearly you can see there's no question about where the trend is in the Australian dollar. We may just fluctuate above and below this 72-cent level, but we did finish the week at 71.6, and so I think still heading for sub 70 cents, in fact sub 69 cents, I think is the next stock. This is the ASX 200. So we were down just a couple of points, but essentially flat on the week. But certainly after a nice breakout, there's been a lot of selling, and a lot of that has happened in the Australian banks. So we'll just look at the finance sector. So the banks has come back into this breakdown area here. So we had important support on the Australian banks. We broke it in March. We spent quite a lot of time below it, managed to rally back into the trading range, which often happens, particularly with stocks that have been market favourites for such a long period of time. They don't, people don't change their view of the world overnight. So it was always likely that we would get some sort of bounce in the banks, but now we've broken back below support again. So the outlook not particularly strong for the Australian banks. All right, so I've covered this. The Australian dollar was down, and the ASX index down by 5. So as I mentioned at the start, in Australia we've got this very tricky balance between momentum and valuations, and it can, if you've got your game plan sorted out, it can be a wonderful environment to trade in. If you're relatively inexperienced, then just be careful about being drawn into the media reports about the high-flying stocks, because there certainly is some danger there. And there's also some really big moves in some new technology stocks in Australia, or let's call them concept stocks. And we've been covering a lot of those in Portfolio Analysts. So I'm really excited about a lot of opportunities, and so far some of them have been extremely kind to me. They're small, they're speculative, they're higher risk, but where you can make some good profits very quickly. Precious metals, gold was down. It wasn't down sharply, it was down $2. I should have amended that, sorry. So we're at $11.95. Maybe just the first sign of some short sellers covering their position, but then again, that's sort of petered out fairly quickly. But maybe the first green shoots that we've seen the worst of the decline in gold. But look, it's going to be heavily dictated by the US dollar, and the US dollar is going to be heavily dictated by the progressive trade discussions. So it's pretty much the open and shut case for gold at the moment. Precious metal stocks steadied a bit. That's the first positive sign we've seen in weeks. But look, it's not really much, as I will show you. Let's look first of all at the gold chart. So this is on a weekly basis. You can see there's not really a lot of movement there. And if we look at GDX on a weekly chart, again, you can see we had a dip earlier in the week, recovered, went positive, and then gave it back again on Friday. So we've broken support by a little bit, and there's not really any positive signs in this, the global gold stock market. But as I've mentioned before, there are certainly some attractive opportunities in a couple of attractive opportunities in the Australian gold market. Turning now to other commodities, copper was pretty steady at 268. Crude gained a little bit to 69, but the pardon me, but the energy sector stocks still haven't regained momentum as yet. But look, I think they will. I think the way this is going to play out, when the trade fears settle down, then I think you're going to see the price of oil start to reflect the supply and demand balance a little better, which means it's probably going to track up into the low to mid 70s. And I think that'll probably get the energy sector moving, because the growth in earnings in the energy sector is very strong. Coming off a low base, admittedly, but it's still very strong. So it's a sector that I'm continuing to watch very closely. I'm not doing anything with it, but I think both energy and financials in the US have got the earnings growth and are trading on fairly low valuations. So that's a good formula once the momentum starts to build in it again. So spot copper not doing anything, and crude oil not really doing anything either. So to wrap it up, there is a significant divergence between the performance of the US market and the rest of the world. That's for sure. And a lot of people sort of point at that and say, well, that's surely the sign of a top, when you've got stocks like Google and Amazon and Apple that are basically holding the index up, and the rest of the world is falling away. It's a nice story, and on the surface it sounds like it might have some truth, but it isn't actually true at all. If you look at the Russell 2000, if you look at how many sectors in America and how many industry groups are trading above their 50-day and 200-day moving averages, the breadth in the US market is as high as it's ever been. So it's a very buoyant scene in America at the moment. And the overwhelming odds are that the US indices are going higher. But just be aware, September is often very volatile, and can then set up, if you can get good entries, set up a very good run into Christmas. Portfolio analyst this week, I'm going to be looking at a couple more local spec stocks that are working very nicely, and I think are really just in the early stages of quite a considerable move. They are speculative and risky, so they're not for everybody, but there's certainly some great momentum there. And I'm going to be doing more on the best, excuse me, the best in the US industry groups. So this is a program that I'm going to be continuing in Portfolio Analyst for perhaps the next 6 to 8 weeks. There's my contact details for those that aren't members of any of my services and would like to communicate with me, and I'll be back with you next week. Cheers.